Okay, cool. I see the first people are pouring in. Welcome, Ken, Manuel, Mike, Pavel, Dutna. Let's wait a little bit for other people to join. How are you all doing today? Hope you can hear me. You guys hear me? If so, can you please say it in the chat so I know that everything is set up correctly? That's good to hear, Mike. That's good to hear. Yeah, I'm doing great myself. Thank you for asking. um, yes, I'm excited to be here again with you guys in this live environment. I mean, just like to interact with everyone. Okay, cool. Okay, I see the yeses pouring in now, loud and clear. Great. Welcome, Hans and Ken. Thank you for joining us. Yeah, let's wait for a little minute and then we'll get started. So this is being recorded, absolutely, and everyone who registered will automatically receive an link to the recorded replay of this webinar. So yeah, that's always the case when I do a webinar. I always make sure to record it because yeah, many people just like to watch it at their own convenience, which I can totally understand. It's always a bit difficult with the time zones, Everyone is from a different place. So, for example, where are all you guys from? Okay. Well, then let's get started. Welcome, Prem. Thanks for joining us. Okay, so the Investing Breakthroughs webinar. What is this all about? Well, as the subtitle says, it's learn from my mistakes. I mean, I've been investing for a while now, and I'm doing pretty well at the moment. But when I just started out, I knew nothing about investing whatsoever. I didn't even know what a stock was, and so today I will tell you my story of how I got started, and yeah, see what you can learn from it. So first, let's yeah, do the common thing to introduce myself. My name is Nick Kraakman from valuespreadsheet.com. Oh wait, yeah, I see some replies coming in now. Hans is from Denmark, Philadelphia, Dante, Mike from the US, California, Prem, India. Wow. Uh, I noticed that a lot of people are, or at least more and more of my readers are coming from India. This is very interesting. I think you guys are definitely trying to or yeah, doing your best to catch up. And I think we will be overtaken by you guys if we don't watch out. So very good. Thank you for joining us. So again, I'm Nick Kraakman, founder of ValueSpreadsheet.com. You probably are at this webinar because you sort of read read my blog, etc. So why did I decided to do this website? Why did I create the blog? Well, because I just hate to see people lose money. And I mean, I know how hard it is to get started, because when I got started, as I said, I knew absolutely nothing about investing, and it was difficult to get started because there are so many sort of self-proclaimed gurus out there, all shouting, different strategies at you, and you just don't know what works and what doesn't. It's very difficult to sort of find your way in the maze of strategies that are promoted, and so that's why I ended up with making some very bad decisions. But I'll get into that some more. And I just don't want you to make the same mistakes that I made. So that's why I try to share what I know and what I experienced on my blog and my videos, and also in webinars like this. So I hope you're going to enjoy it. So I'll share my story and the breakthroughs I made along the way, and hope you can learn a thing or two from it. And at the end of this webinar, you will know exactly how to avoid all of the costly mistakes that I made, and you will be ready to start earning serious returns on the stock market. I am from Amsterdam, the Netherlands, and I'm actually doing this webinar now from my brand new office in the middle of Amsterdam. It's not expensive. It's a very sort of cheap temporary office, but it's very nice. It's a flexible working space, really cool. I'm surrounded by other entrepreneurs and interesting people, so it's a good atmosphere. But yeah, so I'm from the Netherlands, so English is not my native language, so excuse me if I mess up some of the words or whatever. Just I hope you're all right with that. And in the coming hour, I'll try to teach you as much as I possibly can. And after that, I'll show you how you can get more help if you wish, if that's okay with you. So now let's start with the content of this webinar. My investment journey so far and the sometimes painful lessons I learned along the way. Okay, so this is me a long time ago. I didn't know, and these other two are my little sisters. At this point, obviously, I knew absolutely nothing about investing. Then I went to middle school, and during middle school, which was already I think some 10 years ago or more, I sat next to this guy, and this guy is now a very good friend of mine. His name is Thomas, and as you might be able to tell from his appearance, he is a business guy. So he already had this in him back then when we were still in middle school. And in fact, this picture that you're looking at right now is a picture taken for the Dutch newspaper because he started a new business, and this was one of the shots of the which was part of the interview. And he told me about stocks for the very first time, and I knew nothing about them. His father apparently was investing in stocks, and it just sounded like magic to me. You know, he told me that his father had some money, put it in a stock. I didn't even know what it was back then. And then sometimes later he took it out, and it was more than what he put in. So it seemed like magic. And I immediately wanted to start. So I searched the internet, and I found out that I had to open a brokerage account. The thing was that I was younger than 18, way younger than 18. I was around 14 years old, and so my parents had to sign, and they blindly did that, which I'm still very grateful for that, because it allowed me to start investing at a very young age, and not only investing but start learning at a very young age, which is great because when you're that young, you don't have a lot to lose yet. So you can make all the mistakes with the only tiny amount of money, and so I'm very grateful for that. So at this point, I got a brokerage account, a promise of easy money, because that's what I got from my friend's story, and I had exactly zero knowledge about the stock market and how it functioned. So as you can imagine, I felt absolutely ready to put all my savings on the line, and that's exactly what I did. So my strategy was very simple back then. I simply looked at a list of stocks, and I picked the first one that I had heard of. So in other words, I just looked at the list, and then I found a company which I had heard of. For example, I was looking at Dutch companies, so you wouldn't probably know them. So let's take an example. I was looking through a list and I saw Apple. I thought, ah, Apple makes iPhones, right? So yeah, that's an interesting one. So I would click on it, look at the chart, something like you're seeing right now, and I saw, wow, the price is currently lower than it has been in the past. And that was enough reason for me to put my money in. So it's a very simple strategy. I got lucky a few times, and that's what actually made it worse because that increased my confidence while I was actually completely incompetent. And of course, I lost a lot of money in the end. So this led me to my very first breakthrough, which is buy a business and don't buy a chart. Because stocks are simply parts of a business. But I did not realize that at the time. I mean, a stock is not a thing which wiggles up and down in price. Price actually says very little about a company, and price movements are often highly irrational. So a stock is actually, like I said, a part of a business. If you have a company and it goes to the stock market, actually what happens is it gets split up into tiny little pieces, and each piece is called a stock. And when you purchase a stock, you actually purchase that a tiny slice of the business. You become part owner of the business. So it makes sense that you shouldn't look at the chart, but you should look at how the business is actually that you are purchasing a part of is actually performing. But I'm getting ahead of myself. So, like I said, I looked at the chart and saw that and looked if the current price was lower than it had been in the past. But all this tells you is that a company is relatively cheap, but it doesn't mean that it's absolutely cheap. So I will explain the difference this by using this beautiful yellow couch as an example. Imagine you see this couch and it's selling for $1,000. That's the price. Then the next day, it's selling for $500 instead of 1,000. This means that it's now relatively cheap compared to the initial price. However, if the couch is really only worth $100, it is still expensive in an absolute sense. So I had this very flawed strategy of looking only at relative price and not comparing it to what a stock was actually worth. So yeah, I was 14 years old and I didn't have much money to invest. So I realized that even if I had good returns percentage wise, so even if I would make an insane 30% a year, which I didn't, but let's take this as a hypothetical example, um, then still, because my initial amount of money that I invested was so small, the transaction cost would completely destroy, um, yeah, my returns. So actually, I even sent an angry email to my broker because I was just furious that they were charging me so many or such high transaction costs because you know I told them yeah, I made all this money and now it's gone because I have to pay you all these transaction costs. What's up with that? Obviously they told me the truth, and that yeah, I'm just investing with too small amount of money and I shouldn't trade that often, and that really stuck with me. So um, let's see. Yeah, and then what I realized was that okay, so if I have only this time, there are two options. I either have to increase the amount of money I invest, or I have to use leverage, which means that you can earn bigger money amounts of yeah, bigger returns money wise with the same small amount of money that you invest. And this just was very tempting. I mean, I found out about options and also other derivatives like they're called turbos and speeders, and then all they do is provide you with leverage. So they allow you to invest only a small amount of money, and then yeah, you can earn more with less, which seems brilliant, but I sort of forgot that it also works the other way around. So yeah, if you buy something with leverage, when the price goes up, you earn money faster. But when the price goes down, you lose money faster. And this went dramatically wrong. And this caused me to actually lose half of my savings in a couple of weeks. That's scary, right? I mean, just imagine that you have all your savings. I mean, I was very young at that age, but I can imagine that none of you are currently 14 years old. If you are, that's great. Then still, you don't want to use leverage because it can cost it cost me half my savings and in a very short period of time. So these derivatives are like options and turbos and speeders are extremely dangerous if you don't know what you're doing. So I was not very happy, but I learned a lot from it. And this led me to my second breakthrough that there is simply no shortcut to wealth. And I'm sorry to break this news to you, but you know, this is there. Quick and easy gains are something that everyone wants, but it's not. It's simply not possible to maintain. I mean, some people will definitely earn. I don't know. They are buying options or whatever, and they tell you about the 50% return they made in 3 days' time. Well, that's amazing, but they won't be able to keep that up for an extended period of time. It will backfire at some point, and it's simply not worth the risk because it is extremely hard to earn back losses. I mean, if you do the math, a 10% loss requires an 11% gain to earn back the money you lost. But if you lose 50%, it requires a 100% gain to earn back that 50% loss. So it's very hard to earn back losses, and therefore slow and steady wins the race on the stock market. And yeah, that allows the power of compounding to really kick in. So another thing I learned from losing half my savings was that it might not be a great idea to invest every single penny of your savings at once. Instead, I now recommend people to only invest with money that they won't need in the next 5 years or so. Yeah, so you can start with I mean, what I often recommend is that you start with. I mean, the money you invest now uh, has the most time to compound, right? I mean, so interest upon interest. So the more money you can put in at the beginning, the better. But again, don't put all your savings in at once. Instead, put a good enough sum of a couple $1,000, and then every month automatically transfer a small part of your income to your brokerage account automatically. This way, this really adds up over time. All these small amounts, and this is probably the best way to grow your asset base automatically, and while you are not sort of risking your entire fortune at once. Instead, you steadily grow your assets and grow your returns. And also do this automatic transfer of funds at the beginning of the month, not at the end, because if you are like most people, if you won't have any money left at the end of the month to put in your brokerage account. While if you do it at the beginning of the month, you probably won't even miss it. You know what I mean? So that's what I always recommend. So after losing so much money, I realized, and this was one of the painful realizations, of course, that I had no clue what I was doing. I needed a strategy. I mean, you don't drive a car without learning how to drive first, and it's the same with investing. And the legendary investor Joe Greenblatt, he sort of described my situation nicely in this quote. that choosing individual stocks without any idea of what you're looking for is like running through a dynamite factory with a burning match. You may live, but you're still an idiot. You know, it's it's just the perfect way to sum this point up. This led me to a very important breakthrough that you should first invest in knowledge before you invest in stocks. I lost half my savings because I knew nothing about the stock market. I was picking stocks at random, and to make it worse, I was using leverage to make things worse. You know, I mean, that's just um, made it 10 times worse, my losses. That's why I lost half of everything I had at that point. And Benjamin Franklin, he said that an investment in knowledge pays the best interest. And unfortunately, I had to find this out the hard way, but it's really true. The problem was, though, you want to learn about investing, but as I said in the beginning, sorry, there are so many, yes, how do you say that? Sorry, I'm sort of looking for the English word, but you have so many people shouting different things at you that you don't know who to trust, who is right, who is wrong, which strategy actually works, and which strategy do they just proclaim to work. And then I mean I was looking on the internet. It was a disaster because you know the get rich quick schemes are just everywhere, and I didn't know what to do. No, didn't know who to believe. And I was actually looking for sort of a comprehensive step-by-step guide that would take me from an absolute beginner, which I was, to a good investor. I wanted to be confident enough to invest my own money and know that I had some strategy to fall back on. And then I thought the easiest way to become good at something, anything, is by studying what the best in the world are doing. So why should I trust some random guy on the internet if I can look at what the best investors in the world are doing? That's what I did. This is how I found out about Warren Buffett, who is obviously the world's best and most famous investor of all time. He's currently the third richest man in the world, and he earned all his money with investing. So what happened was I found out about this. Again, I'm from Holland, and there was this Dutch Warren Buffett newsletter. I came across it and I subscribed, just like you may have subscribed to my newsletter, because this newsletter I'm talking about now, this Dutch newsletter, it really helped me out because I got an ebook from them, and the strategy they explained, which was the strategy of Warren Buffett, was so simple and it made so much sense. They were simply saying buy great companies at bargain prices, which is, of course, as simple as it gets. But it made so much sense. And like Buffett said, whether we are talking about socks or stocks, I like buying quality merchandise when it's marked down. This is one of my favorite quotes of Buffett, and it just rings so true. You know, why would you do anything else than look for great companies? Because remember, a stock is a part of a company, so you might as well buy a part of a great company, right? And buy it when it's cheap. That makes sense as well. So the reason not many, I mean, Buffett earned billions with this strategy, right? This tiny little quote sort of tells you what made him billions. And then people always ask me when I tell them this, why isn't everyone doing this? Well, the reason not many people apply this strategy is because it takes some courage. Because many people prefer to follow the crowd, to follow what everyone else is doing. So they invest in companies which are hyped by the news and which everyone else is also buying. While Buffett often buys companies no one else wants to own at that moment, you know? This can be very scary. But I mean, his strategy, again, and you probably know this, but I just tell you, his strategy is called value investing. And it often means looking for a great company, then waiting until it gets into some sort of trouble, gets into a situation where I don't know, there's an investigation going on or something. Something scary is happening. Uncertainty uh, is around, and this often leads people to sort of dump the stock. They don't want to own it because people don't like uncertainty. But this is exactly what Buffett is waiting for. He waits until these great businesses, and they are still great businesses. Sometimes they are being investigated, and yeah, the result of this investigation might not be 100% predictable. But you can, if you have a company that earns, let's say, $1 billion in cash a year, and the maximum they have to pay if this investigation turns out wrong is 100 million, which is just 10% of what they're earning in a year, then sure, the company's management is not happy, and you as a shareholder shouldn't be happy with that fine. But still, they can pay that easily, and there's nothing. The business can just continue to operate as it did before, and so these are the moments that Buffett seizes to buy great companies when no one wants to own them. And again, this can be scary, but leads to the best returns. So I also started reading, a lot of books on investing. These are some of the classics, like The Intelligent Investor by Benjamin Graham, who is sometimes called the father of value investing and who is the mentor of Warren Buffett. Um, Also, The Little Book That Beats the Market by Joe Greenblatt. Joe Greenblatt is a legendary investor who, he earned, I think it was, I don't know, but it was more than 30% a year, which he earned for his shareholders 10 years in a row, which is very, very impressive. Um, and finally, The Dondo Investor by Monish Pabrai, which was actually one of the very first books I read on value investing, which was recommended to me by the newsletter I was telling you about. And it's an absolutely amazing book. I read it a couple of weeks ago, and it's still a very great book. So I highly recommend that one. Usually, you only see people recommend The Intelligent Investor, but I think, no, I wouldn't say that. But okay, The Dondo Investor is one of my favorites. So they're all written by some of the best investors in the world, all three of these books. And the funny thing was that I noticed that they were all saying similar things. There were hardly any contradictions. So I realized that these great investors were all applying a similar strategy because they were all saying the same thing: buy great companies at discount prices. And they were all applying this value investing strategy. It sort of made sense to me, and it all became clear. So this led me to my fifth breakthrough, was that the number one way to really learn how to consistently earn money on the stock market is to study how the best in the world are doing it. For decades on end, they have proven that their strategies work, and that there's no better there's no better source of information than their words. So just read their books, find out who the best are in any field you want to be good at, and study what they are doing. And then follow Bruce Lee's advice: adapt what is useful, reject what is useless, and add what is specifically your own, because you don't have to follow their strategy literally. Everyone has their own little twists to it. Just know the basics, know their philosophy, and then give it your own little twist. So just as I was buying my first stocks based on Warren Buffett's strategy, the financial crisis started. So yeah, in fact, I actually bought some of the stocks on the day that the Dutch stock market hit its absolute peak. Literally on that day, I bought some stocks, and so my timing wasn't great. The price of some of my stocks dropped more than 50%. And before, I would have panicked and sold them, but now that I had this value investing strategy in mind, I was confident that my purchase decision was right and that I would eventually still make money with these stocks. And I did. It took several years, but in the end, this still earned me a nice annual return of around what was it, 15% or something, which is not bad for a beginner. However, I realized I had made a huge mistake again, because the crisis made all kinds of stocks ridiculously cheap, and I wanted to buy them all. The only problem was that I was already fully invested and could therefore not benefit from the bargain prices the crisis produced. So I could also not buy more of the stocks I already owned to lower my average purchase price. As I said before, I still made money, but it could have been much, much more if I only had some money left on my account when the crisis hit. Therefore, I suggest to always keep some liquidity so you can benefit from new opportunities. Yeah, and something related to this is to never buy a full position in one go, but buy a small position first, just an entry position, and then buy more as prices decline. Because if you find a great business and you believe that, for example, at $50 a share, it's cheap, then if the price drops to $40, it's an even better bargain, right? I mean, now you can get the same great company for a lower price. And that's a switch that many people find difficult to make because many people run for the exit as soon as their stocks drop in price. I've been reading a lot about Stoic philosophy, which is a ancient Greek philosophy. It's just very interesting to me for some reason, and they constantly tell you to practice difficult situations in advance, so anticipate them, and then practice how you will react when it actually happens. So you could do this with stocks. I mean, imagine what would you do if if the stock you currently own drops 30% in price. Just imagine what you would do and be prepared so that you won't act irrationally once the situation actually arises. But okay, let's get back to the topic. Yeah, so around this time I went to university and I decided to study international business administration because, yeah, I like business, and by now I really liked investing because, yeah, I actually started to earn some money by applying this value investing strategy. And I've been reading so much about all this. And so therefore I decided to enroll in some finance courses as well. However, the thing was, I was sort of shocked because of all the outdated and yeah, I would say wrong theories they were teaching there. This was a finance class in university. I was doing a master's degree. I mean, this should be the top-notch knowledge that we have in the field of finance. But everything I read, everything that was taught in university, like efficient market hypothesis, capital asset pricing model, modern portfolio theory, you don't even have to know what all of this is, but just all of this is, let me just say that many of these theories are based on the assumption that investors always act rationally. And the whole premise of value investing is that investors do not act rationally. And just look around you. I mean, especially when it comes to money, people tend to freak out when they see their stocks decline, for example, and they do not act in a rational way. Same thing when a stock gets hyped, everyone wants to get in, everyone wants to buy, pushing the price up to unrealistically high levels, and this creates bubbles, etc. So there are so many real life examples that investors do not act rationally, but all of these theories that were taught in university were based on the assumption that they are rational. This was all complete nonsense to me. It didn't make sense. Because these theories also said that it was impossible to consistently earn above average returns. But this is exactly what Warren Buffett and other great investors have done for decades at a time, you know? So for my bachelor thesis, I actually decided to investigate whether Warren Buffett's success could be explained by sheer luck, as these theories said it was. It could only be, his outperformance could only be explained by pure luck, However, the result I got was that his returns were so significant, were so high, and for such long time periods that it could not be just luck, but it had to do something with skill and the way he invests. His strategy, his value investing strategy, is why he outperformed, not luck. Which was, again, contrary to what was taught in universities. Therefore, my seventh breakthrough was this: always question conventional wisdom. If the majority of people believe something is true, this does not automatically make it true. Always think for yourself and never believe what people tell you. Don't even believe me don't even believe what I'm telling you, you know? I mean, question everything. Um Let me see. Yeah, so because I was constantly performing the same calculations for each company I was analyzing, I decided to download a couple of Excel spreadsheets to speed up these calculations. And I tweaked them to my own needs. And, I sort of really felt in control because now I was able to analyze all these stocks based on many of Warren Buffett's criteria in sort of in minutes, and then I could quickly decide whether or not to buy them. And I did have some success. At one point, I analyzed an education company called Apollo Group. I ran its financials through my spreadsheet, and it seemed like an amazing company to buy. It was highly profitable, had little debt, and was also trading at a very cheap price. I immediately bought it at a price of around $56. I believe I calculated the intrinsic value to be around $90. So I thought I had a good upside. Um, but its stock price started declining, and I decided to buy even more Apollo Group stocks because, as I said, if it's a good bargain at $56, it's an even better bargain at $46, right? Well, it wasn't until I lost around 50% of my investment that I looked past the numbers and found out that new laws had been issued, which meant Apollo Group would most likely not be able to remain as profitable as it has been in the past. So they were experiencing fundamental business changes, fundamental problems, not temporary ones like the investigation example I just mentioned, where someone has to pay a fine and then everything is back to normal. No, this was serious fundamental problems. And these were not apparent in the numbers alone. The company, on top of this, was also being sued and had to pay a serious fine. And so after the stock dropped an additional 10%, I finally decided to take a loss and get out of this sinking ship. So what did I learn from this, and what can you take away from this? Well, what I learned was that numbers do not tell you the complete story. While spreadsheets can really help you to speed up your research, there is much more to a company than its current profitability. So also try to look past the numbers and find out what the risk factors are. Ask yourself what could go wrong, and read into, for example, what kind of management is running the company right now. What is their track record? Are they allocating capital in a good way? Things like that. Does the business have a competitive advantage which is sustainable? Those questions you can't tell with complete certainty from numbers alone. So always read some uh, annual reports, etc., to get some more research done. Um, yeah. So another thing this dramatic trade taught me was that you do not have to earn your money back the way you lost it. And I held on to my Apollo Group stocks for way too long because I was afraid of taking a loss, especially because it was a huge loss. And this not only forced me to sell at an even bigger loss later, but also meant I incurred significant opportunity costs because I could have invested that money elsewhere. Um, so yeah, whenever you find out you have a sinking ship in your portfolio, like I had, take a loss and invest that money in a better opportunity. Uh, yeah, Jan, thanks for repeating. Good. Okay, so luckily, luckily I learned from this mistake, and I've never experienced a loss like that again. I mean, knock on wood, right? um, Still, I really believed in the power of spreadsheets, so I created some sort of a, yeah, let's call it an Uber spreadsheet, one spreadsheet to rule them all. Yeah, by combining all these Excel files into one, and this saves me a tremendous amount of time when analyzing stocks. And I use this what is now the premium value spreadsheet very successfully for a couple of years. For example, I found this tiny company called Universal Insurance Holdings. Whoops, what is happening? Yep. Universal Insurance Holdings. It was at the time trading around $6 per share, uh, but it had $8 in net cash per share on its balance sheet. So what this means that if the company would go bankrupt that same day, I would still make money because it had more cash than its share price, which is a pretty wonderful situation to be in. And the company also paid a dividend of almost 10% because it was generating so much cash. It decided to pay out a bit of that as a dividend. So this was as sort of as close to a sure thing as I would ever get. However, still, the stock price declined 50%. Even though it was already this cheap, it went to $3 per share, still with $8 of cash on his balance sheet. And because I just suffered this major loss with the Polar Group, I was sort of paralyzed and didn't dare to buy more, because that was the mistake I made with the Polar Group. Still, no matter how critically I looked at Universal Insurance Holdings, there really seemed to be nothing wrong with it. And finally, after 3 years of underperformance, the stock experienced a huge price appreciation. And I took a small profit by selling some stocks at $8, but I believe the company was still significantly undervalued. So I held on and finally sold them at more than $14 per share. And this was a massive 155% return, including dividends. And even if you divide this by the 3 years that I was holding on to this stock, it's still an amazing return. So even though the stock underperformed for 3 years straight, in the end, it earned me a huge return on investment. So yeah, what can you take away from this is that short-term underperformance is okay, and it can happen. So yeah, this is how I learned that you might underperform for a while, but that this does not mean that the strategy does not work. Your annual or your per year performance does not really matter. All that matters is how much money you ultimately earn in the end. And this was something all the books I read about value investing had told me already, but it wasn't until I experienced it myself that I started to believe this. So when your stocks underperform, just take an extra hard look at them, and if you can't find anything wrong with them, just hold on to them. Price and value will catch up at some point. And it was around this time that I read The 4-Hour Workweek by Tim Ferriss, who is really sort of my mentor in many ways. I learned a lot from his writings, and The 4-Hour Workweek is just an amazing book. What is underperformance then? Okay, underperformance is that for example, the market, the S&P 500 goes up with 10%, while your stocks are going down, declined by 20%. That means you are underperforming the general market. Your stocks are not keeping up with the general market, and that's underperformance. Of course, you shouldn't really measure yourself against the market. You should just measure yourself, your own stocks, your own returns against the ultimate goals that you have. So if you want to earn, let's say, 20% a year, you should measure yourself against that and not against what the market is doing. But still, yeah, that's what underperformance means. So yeah, the 4-Hour Workweek is really an amazing book, and it was an eye opener for me because it sort of opened my eyes to the possibility that you do not have to work full time. You do not need a job. You can start your own business. And so that's what I did. I started Value Spreadsheet, the website. I made the spreadsheet itself more professional, added extra functionality. And yeah, this was already almost 2 years ago. I started a website, and yeah, I just tried to um, help as many investors as possible to improve their returns based on the teachings of the best investors in the world, about which I had learned so much, and which I had practiced for a couple of years already with success. Yeah, I also, as you might know, offer some free spreadsheets and videos and resources on the website. And yeah, I have the premium spreadsheet there as well. And I have a podcast, and now recently released a second podcast, and you can check them out if you go to valuespreadsheet.com/podcast. And yeah, it's very interesting. I mean, you can just listen to me on the go if that's what you like to do. I mean, people, I got some pretty positive responses on the podcast, so thanks for that. It's really motivate. It really motivates me. And yeah, while I sort of already knew a lot about investing because I started at age 14, and I read all these books, and I already invested for a long time myself. Still writing all these articles on my website, and making all these videos, etc. It really forced me to keep learning new things, and I did. Every time I write an article, I have to reread some stuff, and I learn about what other people are writing, and I continue to learn, even though I've been investing for 10 years now. And to quote one of my favorite authors, Mark Twain, the man who doesn't read good books has no advantage over the man who can't read them, which is beautiful. I love his hair as well, by the way. And this is why I believe it is very important to never stop learning. And this is my final breakthrough. Even if you think you already know everything, there are always new things for you to learn. And I don't mean that you should read about investing all day, every day. Not at all, actually, because I believe you should learn a little about a lot. That's what Robert Kiyosaki also says in his Rich Dad Poor Dad book, which I also really enjoyed. And Warren Buffett's business partner, Charlie Munger, he also does this. I mean, his children once described him as a book with legs because he reads so much, and he reads all kinds of topics, not just investing. He knows something about law, about statistics, about physics, about and random subjects, but they might all give you some insights into um, yeah, different viewpoints. It allows you to look at stocks from different angles, and it will definitely improve your decision. So never stop learning, guys. Okay, so I started applying a value investing strategy in 2007, and I have been consistently earning above average returns ever since. And to give you an idea, here are all the companies I owned since then and their returns. The first couple are Dutch stocks, so you might not know them. Uh, these returns include transaction costs and dividends, and they do not include my current holdings. And yes, I have been doubting for a long time whether or not to show this list, but I think it might help to bring my point across. Because, and you have to keep in mind that these figures do not tell the whole story, because some of these returns I earned in a matter of months, while some took several years to accumulate. Still, on average, I've been able to consistently earn returns in excess of 20% per year since 2007, and they are still improving. So, 20% on average, but in the beginning I only earned 15%. So it's still improving because, as I said, I keep learning. There are still, every day I learn new things. And remember that this period includes the financial crisis. And I do not tell this to brag about how good I am or whatever, not at all. I just want to show you that you can get a feeling of what is possible if you apply a value investing strategy consistently. You can get returns of 155%, 44%, 81%. It's all possible. And during this presentation, you learned that I absolutely sucked at investing. But because I studied how the best in the world earned money, yeah, I managed to earn these returns. And there's nothing magical about this. Strategy is really simple. Um, Yeah, all you do is find great companies selling at discount prices. 1 second. How many stocks do you keep in your portfolio, and what is the average length? That's a good question. I try to have a yeah, what they call a concentrated portfolio, so not too many stocks. I prefer to have less than 10 different companies in my portfolio at any time. I currently only have 3 companies in my portfolio because I don't see that many opportunities at this moment because many stocks are a bit overpriced. At least that's my opinion. And what's the average length? It varies greatly. I mean, for example, if you look at this list, the second one, Excel Group, I earned that return in just, what was it? I think 9 months. However, if you look at the last one, Universal Insurance Holdings, it took 3 years. Google, it was in less than a year. So it differs. But let's say that it's sort of take 3 years. I think that's also what Joe Greenblatt said in his book, that 3 years is reasonable. So buy a stock. So you should keep this in mind when you purchase a stock for a certain price, because if you think you could earn a 30% return on a stock, this is a good return if you earn it within a year. But if it takes 3 years to get that 30% return, you'll only have 10% a year. So keep in mind that it can take a long time and purchase at such a cheap price that this return still a nice return. So I hope this answers your question. And so again, the strategy is really simple. All you do is find great companies selling at discount prices. And you can do this as well. You can earn these returns. And at the beginning of this webinar, I promised to show you how to get more help if you want it. And that's why I want to just tell you very quickly about my Value Investing Bootcamp. Value Investing Bootcamp is a video course which takes you from a beginner to a confident investor in just a couple of hours of quality video content. So what you get is 3 hours of video content that I recorded in a presentation format with me speaking, similar to what you saw today. As I said, I've been investing for 10 years, been reading a lot of things and trying out a lot of things, and this course really has all my knowledge in one single package. So it took me 10 years to acquire this knowledge, and it took me several months to create this course and put all this knowledge into this one package. You also get a 25-point investment checklist so that you don't forget anything when you analyze a company. There's an intrinsic value spreadsheet included, so you can calculate the value of any company with 3 different models. And there are already more than 1,100 students taking this course. The regular price is $197, which might seem like a lot, but remember, if this course helps you to make even one good investment decision or prevent you from making one bad decision, you probably already earned this money back several-fold. So because you are part of this webinar, I'm offering you my entire video course, including several bonuses, which includes a case study and an additional video for just $97, which is, as you can calculate yourself, a $100 discount. And it's available for if you go to this thing, I also display the offer on the side of the screen. So it's available for the next 27 hours. If you go to that link, valuespreadsheet.com/course. I will show you I will quickly show you. Let me see how I do that. So if you go to that URL, you'll end up here. This is Udemy. This is the website where there are a lot of courses available, and my course is also hosted there. As you can see, the price is just $97. you get a 50% discount, and it's valid until Sunday, which is 27 hours. So yeah, the cool thing is here, down here you can see the entire curriculum. So everything that is included. The first module is an introduction to value investing, defining your goals. Second module about price versus value, because yeah, why do stocks get mispriced? What is value? How do you calculate it? Here's also the spreadsheet included, and an ebook. The risk is covered in the third module. Financial statements, which is very important, and I really tried my best to explain it in an easy to understand way, because many people are often scared when they see financial statements that it's too complex. Well, trust me, you'll understand this explanation that I have. I also included the glossary, which explains all kinds of terminology, and you have a nice clear overview. And then finally, the last step is finding and buying stocks. So how do you find interesting stocks? How do you analyze them? When should you buy them? And there's this checklist, as I told you, several bonus videos, how money works, oops, case study, another little ebook that's included. So you get a whole lot. You go from an introduction to Z and more in the bonus content. Yeah, so as you can see, several people rated it, 4 5-star to 4-star ratings. You can read all about this yourself. I mean, it was nice and fun to learn about value investing, good quality course with lots of data. Well, you don't have to take my word for it. Just read through the reviews. As you can see, 1,183 students already enrolled. When you enroll, you also get have the ability to post questions next to every video, and I'm there to respond personally to every question you ask. And as you can see, this little preview, these two little preview buttons, this means that you can watch the very first lesson for free. So if you go to valuespreadsheet.com/course, you'll get to this page. You can scroll down and click preview, and then watch the very first lesson for free, and then you can see if the quality is up to your standards. Also, there's a 30-day money-back guarantee. You'll get lifetime access, and so I added these bonus materials actually after the course launched. So you can expect me to add additional bonus content in the future, and you'll automatically get that for free. So lifetime access, 30-day money back guarantee. The cool thing is that Udemy has an amazing application which can run on iPads, iPhones, Android, whatever. So you can watch it on the go if you want. You can download the episode, so you don't need the internet connection on the go. And yeah, you get a certificate of completion if you actually complete the course. So again, that's what you get for only $97. Whoops, we're back at the beginning again. 1 second. Whoops. Here we were. Yeah, so again, $100 discount for the next 27 hours if you go to valuespreadsheet.com/course. And if you have any questions, feel free to ask them now, and I can answer them for you straight away. Let's see, Google Hangouts. It's good money to start investing. Yeah, I think it's a reasonable offer, right? And I see that Jan asked me, except for the 3 books you mentioned, do you have some other favorites? Well, yes. Actually, I only recently read, and I'm a bit ashamed to admit this, but I only recently read Buffettology. I'll yeah, I can maybe put a link. I can find a link for you to Amazon or whatever. It's an amazing book, Buffettology. It doesn't just describe Warren Buffett's strategy as many people describe it, but it actually goes into excruciating detail, and it shows that even though in general it seems like a very simple way Buffett invests, just buy great company at discount prices, as I mentioned several times before. But in Buffettology, you really learn that there's so much more involved. I mean, he pays so much attention to taxes and to inflation and staying ahead of that, and um, there are so many little intricate details that are explained in this book. So that's one of the books I can highly recommend. Also, as I said, 4-Hour Work Week. Um, let's see, I'll display the Buffettology link there. Yeah, you paid the higher price. Oh yeah, the thing is, as I said, I host the course on Udemy, and they only allow me, because the initial price was actually $300. Okay. However, Udemy did not allow me to put the course on there for $300. I had to lower it to below 200 in order for them to actually list my course publicly, and so that's why it's now $200. But in fact, it was initially $300. So now you can get it for just 97. So yeah, that's the deal I'm giving you right now for the next 72 hours. So if you have any questions, please let me know. If you have any questions about value investing or um, other things related to investing, you can also ask me. How do you determine if it's time to... Oh, let's make my screen a bit bigger because I can't really read it. How do you determine if it's time to sell a stock? Is that when your intrinsic value is reached or a particular length of time? No, not time does not really play a role. I have several reasons for selling a stock. One is indeed, as you say, when the price approaches the intrinsic value, because that means that there will be less upside left. And I might be better off putting that money in a stock which is, still greatly undervalued and which offers me a bigger upside. Also, as I described with the Apollo Group example, if I start to notice that a company is starting to experience serious fundamental problems, then that's definitely a reason to get out. That's what I learned. That's one of the things I learned. So that's also a reason to sell when the stock is experiencing fundamental problems which are likely to last, or which are likely to do significant damage. And let's see, do I have another reason to sell? Oh yeah, well, if I just find a better opportunity. So it's similar to the first reason. I mean, if I have a stock that has, in my opinion, 10% upside left, and I find a stock that has 40% upside, then I'm better off to sell the first one and put it in the one with 40% upside. So how is value investing different or similar to DGI? I don't know what DGI is. Can you explain what that is? Then maybe I'm able to explain the difference or the similarity. I just don't know this acronym. So Jan, how much time do you actually spend researching a stock before you buy it? Well, I have been able to drastically reduce that time, as I said, by using the value spreadsheet I developed, because it allows me to simply enter a ticker symbol, and then I get, you could say, a full analysis of the company's financials, and in one view I can see which parts of the business are actually doing really well and which parts of the business still need some more attention. So I can really do a focused analysis of a business, and this greatly reduces the time it takes to analyze a stock. But yeah, in general, I could analyze a stock in less than a couple minutes. But if I really want to put serious money into it, Yeah, sure, I have to read some annual reports, and that takes most of the time. But the initial check of the financial figures and the financial statement data is really quick thanks to the spreadsheet I'm using. Carlos, hi Nick. Dividend growth investing. That's Hi Nick, how are you? Just want to know your opinion to dividend stocks and growth stocks. Okay, cool. That's similar, I think, to Doodnout's question. Um, Dividend investing. Yeah. Okay. What can I say? When a company earns money, it then has the choice to either reinvest it back into its business for growth, which is called retained earnings. It retains the money it earns and reinvests it back into the business, or it can pay it out or part of it out as a dividend. So if a company decides to pay you money as a dividend, it has less money left to reinvest into growth. So if you find a company that earns a, let's say, 40% return on equity, which is high, but still they are there. So let's say you have a 40% return on equity, and this means that every dollar, if you make it a bit more, if you simplify things a bit, this means that every dollar they reinvest into the company will earn an additional 40 cents in profit, because they have a 40% return on equity, and 40% of $1 is 40 cents. So for every dollar they reinvest, they earn a 40% return on it. So would you rather have them pay out some money to you, which then get taxed first? So you get taxed, so you get less money than they're actually paying out, and then you have to find another opportunity to which will earn you a 40% return on investment. I mean, this is a very difficult task. So in my case, I would say if you find a company that is that great, that earns that high of a return on equity, then let them keep the money, don't pay a dividend, and reinvest it back into the business so that it can compound at 40% annually. You know, so I'm not a huge fan of dividends. I'm only a fan of dividends when it makes sense, business-wise. So if a company is getting bigger and bigger, it doesn't have that much room for growth left. For example, in Apple, which is already huge, then it makes sense to pay out some of the money as a dividend. Um, Otherwise, no, they should keep it and reinvest it. So that's my opinion on dividend stocks and yeah, growth stocks. I would say uh, growth stocks when there is still room left for growth, then yeah, sure. However, I'm always or a bit scared for stocks that are growing too fast, or that are because is the growth sustainable? That's the question. If you try to calculate the value of a company, growth plays an important role in determining that value. So if you are calculating or are expecting a 25% growth for the next 5 years or 10 years, and it's very hard to actually meet those expectations. So that's always a bit tricky with growth investing. You have to be really conservative with your estimates. And how is value investing different from dividend growth investing? Well, that's a bit like I just said. Uh, that value investing, you try to find a company that is expanding its value, which means it is growing, which means it has to reinvest a lot of its profits back into the business to fund this growth. So yeah, and dividend stocks, yeah, they pay out this money, they don't reinvest it. So that's how it's different from value investing. So Hans, hi Nick, thanks for the webinar. It were to be subscribed to Value Line or the Motley Fool Premium, or one of the like to access the financial data, or you think it is a waste of money because you can find all data on Yahoo, Google, etc. for free. Um, Well, Hans, these services you mentioned do offer more than just financial data. So I think they do have, I'm not subscribed to any of them, but personally, but that doesn't mean that they're no good. I mean, they do cost a lot of money oftentimes, and then yeah, you have to consider, is it worth it? Do they offer me something that is worth that amount of money, or am I better off just doing my own research and investing that money instead and earning a return on it? However, yeah, if you can try them out and then see if they um, yeah, give you the value, give you value for your money. I can't tell you from experience because again, I haven't subscribed to any of those services. Um, but yeah, I mean, it's always I always try to encourage people to do their own due diligence and don't sort of listen to sort of cancel out all the noise. So don't follow the news too closely. Don't uh, that's why on my blog I try not to mention stock tips. You know, I try to tell you the general philosophy, the general way of thinking, and then you can make your own decisions based on that thinking. Because you have to think for yourself and don't follow the crowd or and that's the problem I always have with paid newsletters, which gives you a stock tip every week, is that you tend to follow what they are saying, and it sort of messes with your rational judgment. So that's my opinion. It wasn't a very succinct answer, but that's how I'm thinking about that. So Jan, do you have a lower limit for historical return on equity of a company before you invest? I think my 10-year hurdle is at least 10%. What's your thought on share buybacks? Okay. Yeah, return on equity of a company, I'm always aiming for 15% or higher. Again, that's what I learned from the investment newsletter. And as I said, I recently read the book Buffettology, and there it is also mentioned that Buffett is aiming for 50%, 15% return on equity at least. So yeah, that's the threshold. And the thoughts on share buybacks, same thing as with dividends, only if it makes business sense. And when does it make business sense? When a share is trading below its intrinsic value. If a company buys back its shares at this very low price, it is actually generating more value for the business. So only if the management is buying back shares at a price below its intrinsic value, does it make sense? And then it's actually very good, a very good thing for shareholders. So yeah, I actually like buybacks because generally managers do it at the right time. Uh, yeah, so just make sure that they are buying it back at a good price. And yeah, gurufocus.com is a great website for 10 years of free financial statement data. They also have a premium version which covers, because you say US stocks, but they also cover Europe and Asia. You have to pay them for that. So if the shareholder reinvests the dividends, then he owns more shares and gains more stock as the price appreciates in the. Yeah, that's true. However, you have the taxes you have to take into account. Um, if a company pays a dividend, you pay a dividend tax, and then you have less money to reinvest. Also, if you reinvest the money, you have transaction costs. So it is actually, if you look at it very strictly, it is better if the company just keeps the money and reinvests it. Um, it has a higher potential for the highest possible returns. So yeah, if you guys have questions, please ask. Again, this offer stands for the next 72 hours. You will receive tomorrow a link to a recorded replay of this webinar, so you can just watch it at your own convenience. If you missed something or just want to, yeah, whatever, if you want to watch it again, I don't know if you would like to do that, but you could. And so yeah, the boot camp, it's really, I put a lot of effort into it. It took me several months and a lot of blood, sweat, and tears. I mean, I really wanted to make it the best possible course on value investing that there's currently available. And yeah, to be honest, I think I sort of succeeded. I mean, you've seen the reviews, everyone seemed to like it. And yeah, I try to explain everything with very clear examples. And you will see that if you follow the free first lesson, or if you go to valuespreadsheet.com/course, you can follow the first lesson for free, and then you can see yeah, you can see what I'm talking about, and how the rest of the course is structured. So yeah, I thank you all for being here, and I wish you a great day. And I'll see you. Yeah, next month we'll do another webinar. I don't know what I'll be talking about then, but we'll see. We'll make it a nice webinar. So thanks for being here. Thanks for spending some time with me and with each other. And yeah, until next time. Bye, guys.